Hey guys, welcome back to the channel. We got a lot to go over today. We're going to start with some AMD updates. I know we released a short earlier today that extensively goes into it. So if you want to hear more about that, go check that out. And then we're going to go over some of the economic factors that are happening right now with the war and just kind of where we think this market's going. And then afterwards, we're going to show you just kind of how the market's been performing and how you as an investor can get ahead of the curve. But before we get into it, if you enjoy what we do, make sure to leave a sub, leave a like, subscribe, leave some comments, tell us what you want to see in future videos so that we can go back and we can do that for you guys. Okay, so here's AMD. It's at 220 right now. It was up 7.5% today. And now many of you might be like, why is that happening considering the market's been, kind of iffy. So as you can see here, Intel and AMD reportedly set to raise CPU prices by up to 15%. Now, as you can see in the article, I mean, it says that an average price hike of 10 to 15% is coming for the CPU industry, and we can expect both Intel and AMD to raise prices according to this. So that's not the greatest for people who actually buy these chips, but for us as investors, that's amazing because it's going to raise their top line growth and we're going to see it reflected on their balance sheet. And we're going to see metrics such as their margins and net income be raised for that. So as an investor, we're very happy. So go check that out if you guys want to see more about what we're talking about with that. But look at this oil price right now. WTI crude oil up to $90 right now. That's insane. I mean, there's no other way to put it. That's because of what's happening right now with the war. But the average that we usually sit at is around $55 a barrel. It's sitting at $90. And at the start of March, it got all the way up to $110 a barrel. That's a huge recession, inflation sign and signal. So we do not like to see that. And like I was just talking about, Iran, this is kind of a little bit about just a touch up on the war. Iran says it has no plans for negotiations with the US, which means that this war can continue to draw out because of this. If you've heard about it, Trump just reported that he wanted to do some sort of peace treaty, kind of de-escalate this war and kind of end it. But they were like, nope, we don't buy it. We think that he's calling cap on us. So Iran does not, they responded negatively to this. So they do not want to end it. And what that means for the market is it's going to draw out this stagnant place the market's at right now for a lot longer time than what it should have been. And that means that inflation and signals like the WTI, the crude oil, and commodities are going to continue to raise. And that's going to put us in a very bad state as an economy. So I went onto Google and I was like, let me just search it up just to show what I'm talking about. I was like, what kind of implications does a drawn out war have for, the economy? And like, as you can see right here, rising oil prices, particularly from conflict, also raises costs for transportation and production. This often leads to stagflation, where economic growth starts to slow while inflation is rising. And also, a lot of government spending to accommodate for this puts the economy at very low growth. So, if you don't know what stagflation is, it's right here. Stagflation is an economic cycle characterized by slow growth, a high unemployment rate, and high inflation. That is not what we want in an economy. That's very bad. That means we have slow growth, but we also have a high number of people not working. And in terms of the market, when it's a stagnant market, it means that you'll have, some really good days and you'll have some bad days. But overall, you're pretty much going to remain at similar levels and not have any good news to go off of to raise higher. So most we do not want that as an investor unless you have a lot of capital, because that means that since we're at such low prices right now, you can continue to buy in each month until this starts to raise. So investors, we're benefiting because we get to put in more money and continue to buy at crazy good cost bases. And when we reverse out of this, it means that we're set up to have a very good year or years coming out of this. But in terms of the actual economy, that's not good at all. So let's just take a look at some of the indexes and some of the market right now. I don't know where my face just went, but anyway. So if you can look here, this is the VIX, the volatility index. It shows how volatile the market is. Usually it's inverse to strength in the market. So if the market is going very high, it means that the VIX is typically doing the opposite and reversing and staying kind of dormant at the bottom levels. But as you can see, this year alone, it's up 70.5%. That's terrible. That just means that we are going in a bad direction. The market is reaching kind of bottoming points, not necessarily, but it means that the market's descending. And a good rule of thumb is honestly anything above 30 is a huge buy. Anything over 40 is an incredible buy. And anytime the VIX is above 50 or more, such as April of last year, April 7th got up to I think 54. Anytime then, you should kind of be all in. You have to put everything in because you bounce out of that with incredible returns. So right now, it's not crazy high VIX, but it's definitely moving towards that direction. Now, if you look at like here, the S&P right now, year to date's down 4.5%, pretty much. You look at the Qs, the Nasdaq, that's down 5.2% this year. And you look at typical stocks right now in the market, just typical growth stocks like a Tesla is down 16% year to date, and it's only been 3 months. Look at something like a Wynn Resorts, such an easy company to buy into. You know, the creme de la creme, the top dog, top competitors in the resorts and luxury hotel space, they're down 15% as well. Look at Nike, the best to do it in the retail, like apparel brands, and they're down 17.5%. Look at something like PayPal. You know, everyone knows PayPal, everyone knows Venmo. They're, the same company, down 24% this year alone. But then look at stuff like I just showed you, crude oil is just up so much. And then you look at like commodities. You want to see these stagnant. You want to see them under 20, but they're at 30 right now and they're up 32%. And I have these classified down here in recession signs because these two are key metrics that show that. And you do not want to see what we're seeing in both of those right now. That just means we are set up right now for a disaster for the rest of the year, pretty much. And if this continues, definitely for at least halfway through next year as well, up until maybe midterms. So this isn't great right now. We are definitely not in an ideal spot, but I just want to say, as an investor, the best thing you can do in situations like this is to remain positive and continue to have a positive long-term outlook as your companies continue to go through what they're doing right now. Many people get stuck up and concerned about the levels that they're at and seeing their portfolio red day in, day out. I'm just here to say you should not be worried about that stuff because all that short-term fear, that's all here today, but it's gone tomorrow and it won't be here in the next 1, 3, 5 years. And that's where you're hoping as a long-term investor to hold your assets for that period of time. So continue to have a positive outlook. Make sure that you can get some income in so then you can purchase in these levels and come out with tremendous yields and returns. That's what you want to do. And that's the best way right now that you can position yourself to continue to perform at a level that outperforms a typical index like the S&P or the Qs, like as you can say. So, yeah, just make sure you guys continue to have a long-term outlook. Don't get caught up in all the short-term stuff and just continue to run your projections and look at companies that you believe will be strong in the next coming years and hopefully next decade as well. So if you guys like the video, drop all that stuff. We'll come back with another one. So we have a lot coming out this week, so stay posted with that.